Imagine for a moment that the price of all your investments, your stock portfolio, your retirement funds, your house, were to suddenly drop in half this year. And now imagine that on top of that, inflation were to suddenly pick up, making your cost of living skyrocket. And that would be pretty awful, right? Well, this might not be just some sort of theoretical thought exercise. Highly respected financial researcher Jesse Felder warns us that these twin dangers of a market crash and higher inflation actually could indeed happen soon.
If you think about that, I mean, the stock market would have to fall, 30, 35, 40% just to get back to the peak valuation we saw in March of 2000. To me, that is just absolutely astounding to see valuations so just off the charts right now.
Welcome. I'm Adam Taggart, founder of Wealthion, where we help you make sense of money and the markets by bringing you the insights and wisdom of the world's top experts on investing, economics, and personal finance. In this video, we're bringing you another great discussion in our ongoing series we call Insights from the Masters of Wealth. It's a discussion on market crash risk and inflation that I recorded 2 months ago with respected research analyst Jesse Felder, but it's even more relevant today given the current market conditions. But before we get started, please just take a quick second and click the subscribe button below. This Wealthion YouTube channel is brand new, so each new subscriber we get helps ensure that we can continue bringing you these amazing guest experts. And with that out of the way, let's start watching this interview with Jesse Felder. Today we're joined by Jesse Felder. Jesse is a former Bear Stearns financier and co-founder of a multi-billion-dollar hedge fund, but you probably know him because he's the founder and editor of the Felder Report, a highly respected market research firm. He also hosts and produces the Super Investors and the Art of Worldly Wisdom podcast. Jesse, thanks so much for taking time out of your busy schedule to join us today.
Hey, glad to be here, Adam. Thanks for inviting me.
It's a real pleasure. So I'd like to try to start without introducing any of my biases first, Jesse. So if I can just sort of toss a question out to you, what is your general assessment of today's economy and the markets?
Well, those are two very different things. Obviously, we're still seeing, 800,000 jobless claims every week, which is far worse than the worst we saw during the financial crisis. And the markets are screaming to not just record high prices, but record high valuations across most of the metrics that I use. And so there's a big difference between what's going on in the real economy. Now, I do think we're probably going to see a major boom in the economy after we start getting the majority of the population vaccinated. Some may argue that's what the markets are trying to price in. I think they've priced in that and then some. But I do think there's a lot of pent-up demand in the economy right now that once it's unleashed, we could see some very strong economic numbers and probably inflation numbers too.
Okay, and so let me just dig a little bit more before I maybe introduce some of my biases here. But you note the difference between kind of the underlying performance of the economy and where the markets are valued right now. How concerned are you either about either of those? About the economy's ability to get back to sustainable economic growth, and then how concerned are you that the markets, if they're not fairly valued, that might be overvalued?
Well, I do think, that a lot of the economic boom that we're going to see is not just pent-up demand, but it's also, going to be a product of all of the fiscal stimulus that we've seen. I mean, unprecedented amount. Biden's trying to pass, another whatever it is, $2 trillion of stimulus, $1,400 checks that are going to a lot of people who don't necessarily need them. And I think that probably also helps to explain what the stock market's done. To me, I addressed the economy in that first segment, but I didn't really address the stock market. To me, when I look at those valuation metrics like the Warren Buffett yardstick, as I call it, which is just market cap to GDP, we're 30% plus higher than we were at the peak of the dot-com mania. So if you think about that, I mean, the stock market would have to fall 30, 35, 40% just to get back to the peak valuation we saw in March of 2000. To me, that is just absolutely astounding to see valuations so just off the charts right now. And what a lot of people have been saying, I mean, yeah, valuations have been high for a long time, but we haven't seen the retail speculation kind of come into the market until the past 12 to 18 months, really. I think we started seeing it pre-pandemic. And then in the March crash of last year, we saw retail really jump in with both feet. And I mean, you can see it in a number of Robinhood accounts that are being opened, volume, in penny stocks. You can see it in options, the volume in call options. To me, it's crazier than anything we saw during the dot-com mania. And so I think we have sentiment, valuations, all these things pointing to me that we are witnessing a blow off, mania like we've rarely seen before.
Okay. Good in the sense that I was going to wander kind of into mania territory and wanted to know your position on it. It sounds like you do think that we are in one and perhaps in the later stages of one. And you mentioned a number of kind of metrics there. And just so you know, Jesse, on this program for the past bunch of months, we've had a number of experts who, where we've talked about, many of the signs that are out there that show that the markets are really at unprecedented and, in the opinion of many of our guests, very dangerous levels of overvaluation. Looking at some of your recent work, I see that you've focused on some other interesting indicators that I haven't heard mentioned too often. One, you use a great quote. I won't mention it here, but a great quote from John Kenneth Galbraith, talking about looking in at margin loans as I think he calls it an index of the volume of speculation, which basically means that as more margin loans are made, the more margin loans are made, the more speculative the market environment is. People are willing to make those riskier loans. And you pull up a great chart, which is margin debt to GDP, which I'll superimpose here. And if you look at it, the margin debt to GDP ratio has never been higher. And yes, GDP came down a little bit with the coronavirus's impact on the U.S. economy, but the absolute amount of margin debt is the highest it's ever been. So this isn't just a wonky little blip because GDP dipped. This is legit the highest margin debt to GDP ratio we've ever seen, which may lead us to conclude that this is the most speculative era we've ever lived in. So I guess my question for you is you talked about all of the stimulus money that's flooded into the world, both fiscal and monetary stimulus over the past year, and it's been multi-trillions of dollars, unprecedented. We've never seen that type of that scale of stimulus before. Are we potentially living in a different era now where we can sustain these crazy extremes, or will history just, as it sort of often does, just, prove to be right here and we'll see some sort of reversion to the mean?
Well, I do think it's impossible to time, the ending of these types of manias. They famously go on longer than anybody thinks, but I do think when you get to the speculative fervor that we're seeing today, it just requires an incremental.
I love the excremental adjective.
That Freudian slip. My bad. An incremental amount and an exponential growth in the amount of money that's coming into the market, into call options and into these types of things. And without that, so at some point it becomes very, very difficult for more and more money to come in and sustain it. And I think we're getting very, very close to that. The thing with margin debt too is it's not just that market cap to GDP, or sorry, margin debt to GDP number at a record high. The rate of growth in margin debt we've seen over the last 9 months was actually faster than anything we've seen before either. And to me, the only other times when we've seen margin debt grow 50% over a 9-month period was at the top in 2007, at the top in 2000, and a couple other times prior to that. But every single time, with the exception of 1983, was the only one that marked within a month or two the peak of the stock market mania that we were seeing at the time. So to me, it's not just astounding to see that amount go to a record high, but to actually increase at the fastest rate we've ever seen in history. So you're starting off a huge base already. We are already very close to record highs in market cap to GDP. And then over the last 9 months, it soared 60% in the amount of debt that people took on in their trading accounts. I mean, a lot of that, you just look at like Robinhood, and they're so quick to approve margin and call options and these types of things in these accounts. It's not surprising to me that margin debt increased so fast. It's amazing to me to see it off of such a huge base grow so fast. To me, it's just a testament to the amount of speculation that we're seeing in the market. It's like nothing we've seen before.
Hey, great points. And you have a chart showing the increase in margin debt that I'll superimpose when you were making that point. I just got a question for you, and I'm asking you to speculate here, so I'm not going to hold you to this. But, Robinhood has, been a game changer where it's really provided access to the financial markets to millions and millions of people that really weren't engaging with them before. And as you said, so many of those new people they're trading really aggressively, right? I mean, they're buying call options and Tesla and stuff like that. And we had a wonderful previous update here with Jim Bianco, where we talked about some of the really good things that are coming out of that, where there's beginning to become this sort of collective action that the retail investors can band together and kind of punch back against some of these hedge funds with some of the unfair advantages they have. But the question I have for you is, if we're at this height of a mania, and if we get the type of correction you're saying we could, 30, 40% drop just to get back to the heights of the previous bubble, right? So, we could easily go further than that. What's the collateral damage going to be like amongst the Robinhood crowd? I mean, are those platforms sort of setting up a lot of, smaller, less experienced investors for a really painful, cascade of losses if this thing actually corrects? If this market margin debt spike is presaging yet another big major market correction.
Yeah, I do think so. And I think we're already seeing examples of that where people have gotten really hurt in GameStop recently. There was an article that I tweeted today, it was in Business Insider. It was a young guy, mid-20s or something, who had actually saved up $70,000 in his Roth IRA. And through, being, on these Reddit boards, Wall Street Bets and using Robinhood, he was doing the right thing before and just kind of saving and investing it, to grow slowly over time. He, was essentially psychologically manipulated into taking that 70 grand and speculating in call options, lost it all, has been contemplating suicide since then. I think there are going to be a lot more examples of this. And it really comes back to me. I've done a lot of reading and research about, social media, over the past 5, 6, 7 years, just because I was curious. I was interested to see how it was affecting my kids and affecting myself. And a lot of these Silicon Valley companies have taken the psychological principles learned, that, casinos have used and all these types of things to trigger dopamine and get people addicted to using social media. And Robinhood has taken all that, Silicon Valley's learned and applied to social media and married that with the greed and the business of Wall Street, which is give people what they want. And so you are addicting people on this platform to trading the most aggressive types of things using margin and call options and things, and using dopamine rewards and, this confetti that goes off. And they're basically manipulating people into trading, call options, because that is also the most profitable side of their business, is selling that call option trading volume to Citadel. And so to me, it's hugely problematic that a lot of these people that, have become addicted to social media and others are now addicted to trading. And it's the same dynamics that have got people addicted to social media. And now they're addicted to buying literally deeply far out of the money call options that expire literally tomorrow. I've been watching this dynamic for the last 12 months, and we saw it in Apple and Tesla, largely last year. We saw it in GameStop this year. But the volume of calls that are literally like 50, 60, 70, 80% out of the money and expire in less than a week's time, it's amazing to see how much money is flowing into those things. And you can't come up with a more aggressive, riskier, more speculative security than that. And the trading is off the charts. And so, yeah, I do think it's hugely problematic. And there are going to be a lot of stories like this kid who, lost everything because they were swept up in this. The other point that I'll make is, it's a famous quote, I think it was JP Morgan, is nothing so undermines your ability to make rational decisions as seeing your neighbor get rich. Today, this is on steroids, right? We're having not just seeing your neighbor get rich, you're on Reddit and you're seeing all these people posting, I made $300,000, $400,000, $500,000 with these Tesla call options. And there's dozens and hundreds of stories like this. It's this JP Morgan quote, but the internet and especially social media has worked to make it just in overdrive, psychologically. So yeah, it's fascinating to watch, but sadly, I think there are going to be a lot of people really hurt, in this thing before it's all said and done.
Thanks. Well said. I really share that concern. And for folks watching, a great video to go see on Netflix sort of around this topic is The Social Dilemma, which goes into a lot of the kind of, psychological and neurological triggers that the social media companies are, basically exploiting in people to get them addicted to social media. And as you say, Jesse, the Robin Hoods of the world are using that just applying it to the investing space. It's hard because, I find myself, I lean more sort of libertarian minded and let's let people make their own decisions. Let's not be a nanny state and tell people what they can and can't do because we quote unquote know better than them. But I'm seeing a lot of the same thing that you're talking about here. And on a bigger level, I'm just so frustrated because, one of the reasons why there's so much capital in the markets is because we have killed the incentive to save. We've basically treated or taught our society to not be savers. We've said, look, if you're going to keep your money in cash, you're going to get punished, right? You're going to get no return on it. It's going to get eaten away by inflation. And to your point, look at all these other people who are getting rich, easily, buying into all these other assets. And so, people are getting pushed, across the risk curve to increasingly higher and higher risk to get any return on their capital, right? And now what we're doing is we're basically killing the mindset of investing, and we're really replacing it with a mindset of speculating, right? So what we're going to do is when this bubble bursts, if indeed it does, I fear the collateral damage is we're going to end up with a society or a populace that has been trained not to save, been trained not to invest, and they don't want to speculate anymore. And I don't think that's healthy for anybody.
Yeah, I mean, it's absolutely, think about the missed opportunity for so much, good work that could be going on for people to be spending their time doing things, that are actually productive.
And capital that could be productively applied
absolutely.
too. Right?
And so, yeah, it's hugely problematic in that respect. And you're absolutely right that we have, created more and more a society of consumption. And that's, you can't talk about this without talking about the Fed and, the interest rate policy and consistently trying to pull demand, from the future. And, I've been wondering for a few years now, okay, where do we get to the point where we've pulled all the possible demand from the future that we can? And then there's just a vacuum of demand because everybody's bought everything they wanted to buy. I think we're sort of seeing that, in terms of, you look at loan growth at the big banks and credit cards are being paid down, a lot of that's people haven't been able to spend. And so there is that pent up demand. But, the banks have been, having a hard time making loans for years now. And they're trying to get, money's essentially free. And, and so this is why the Fed is so afraid of the zero lower bound, as they call it, because you get to the point where you've essentially taken rates to the floor. You can't go any further, and this game of pulling demand from the future just stops working. And so I think that's probably a risk that the markets don't really appreciate enough. And the flip side of that too is the Fed keep continuing to push in this direction. There's going to be inflation, and to me right now, that's the biggest risk to markets. Markets are pricing in low interest rates for as far as the eye can see, and low inflation for eternity. And so any hint that rates are not going to stay low forever, and that inflation is going to be a problem in the near future, means a lot of these trades have to be unwound. And to me, that it spans everything from SPACs to cryptocurrencies to growth stocks. They're all potentially at risk to this. Even inflation just even barely rearing its ugly head. But we'll just have to kind of pay attention to that.
Yeah, that's been a theme that we've been hearing emphasized quite frequently in a number of our past interviews here. Grant Williams, Jim Rogers, Steen Jacobson, Jim Bianco, a few others. They're really, I think it's becoming clearer and clearer in the landscape that inflation is going to become kind of the big bad of the next decade or so, and it's something that we really haven't had to deal with for many decades. And so there's no musculature, there's no institutionalized knowledge on how to deal with it. We're quite unprepared because there are a few people left who have actual life experience investing in an era of secular inflation. If there's anything else you want to say about that, I'll let you say it. But I just want to comment on one thing that you said, which was, what we're doing, in this sort of, you said pulling demand into today, by creating these asset bubbles, or at least try to be a little more fair, by dramatically raising asset prices this fast, especially by multiple expansion. What we're doing is we really are bringing tomorrow's prosperity or tomorrow's returns into today, right? So you look at folks like John Hussman, who have their calculations that the projected market return of the next decade is negative, given how high valuations are from their historic means, right? And so you combine that, right? So we've kind of pulled all of tomorrow's gains into today, and then all of a sudden now we're going to have inflation going forward, right? Which is going to diminish the purchasing power of the currency and increase the cost of living. And Jesse, you mentioned you have kids, I have kids, a bunch of our viewers here have kids. Like, what are our progeny going to say about us? Right? They're going to say, geez, guys, thanks so much. You basically just stole all of the prosperity that was due to my generation. You blew it early. You left us with a higher cost of living, a devalued currency, and by the way, a crumbling infrastructure that you didn't put any of that capital to really good use for. I mean, do you kind of have those same worries as well?
Yeah, and I think we're already seeing that. I think the kids are already telling us, hey, we're not happy with what the world that you guys have left us. I think a lot of it comes back to this idea, and it's not an idea, the fact of wealth inequality. And I think that's behind these trades like GameStop. Obviously, a lot of the GameStop trade was, let's just see how much money we can make. But a lot of it was, and a lot of people bought into this idea of, let's screw the hedge funds who have been manipulating markets for years. And it's not just that. I mean, a lot. Look at the thesis, for buying Bitcoin, right? The thesis for buying Bitcoin is the world is going to hell in a handbasket. The dollar's going to go down, be debased, devalued dramatically. The way you protect yourself is by buying Bitcoin. And so I think this younger generation, Gen Y and millennials, are already, tuned into this idea that a lot of mistakes have been made. I don't necessarily agree with let's screw the hedge funds by buying stocks like GameStop, nor do I agree with Bitcoin is the appropriate answer to these problems. But I absolutely understand the sentiment. And just a little bit more on the inflation topic. To me, I viewed this as the Fed is going to have to make a choice between, I frame it as between the devil and the deep blue sea. When inflation starts picking up, they're either going to have to raise interest rates to fight inflation, and you're going to get an asset price bust, right? You raise rates as soon as they start hinting they're going to raise rates, the asset markets are going to start to wobble. If they are forced to raise, rates, to 1, 2, 3%, I mean, you get the risk-free rate at 3%, there's no way you're going to be able to sell a single SPAC. People are going to lose interest in Bitcoin and these types of things. And so either they do that and risk the another asset price bust, which is the devil they know, or they say, you know what? No, we're going to let the economy run hot. We're going to keep rates on the floor, regardless of what inflation does. And then you risk the prospect of hyperinflation, which is something that William White has talked about. And he said, when you get a government that is highly indebted with very low interest rates and inflation picks up, and you can't raise rates because everybody would immediately realize the government can't afford higher rates. The government would essentially be insolvent without money printing. That's when inflation goes out of control. And so that's the flip side of it. So I think, Jay Powell and the Fed, they're going to be faced with this very important decision. And it's, neither outcome is very pretty.
Yeah, it's going to be, trying to pick the least worst option. And as you said, you're stuck between the devil and the deep blue sea. Look, I wanted to ask you about corporate fraud. I just don't think we're going to have time here because you've already given us a ton of time. Hopefully I can have you back on at some point in time to talk about that because you had some really interesting recent observations about fraud. If you've got anything quick, feel free to mention it. Before I get to the last major question I want to ask you, I just want to put you on the spot a little unfairly. So you sort of talked about this one of two directions. Do you have a speculation as to which way we're actually going to go?
I think probably the Fed has said they want to let the economy run hot. And I think, that this is why I had, you mentioned John Hussman. He has said to me, he thinks it's possible that we've pulled forward as much as 25 years worth of returns now forward into this stock market. We could have that long of a kind of a Japanese style, bear market. But I also had Daniel DiMartino Booth on my podcast recently to ask her this very question: is how much hubris, right, is involved with this decision to let inflation run hot? To me, you're playing with fire, and I worry more about that side of it, because if they do keep rates low, I mean, they'd have to use yield curve control to also make this happen. Even if inflation's picking up, you risk this spiral. And I do think even if you do get that kind of a hyperinflationary spiral, and I'm not talking about inflation in the teens. I'm talking about if you are holding interest rates at 0 to 1%, 2% maybe across the curve, 5, 6% inflation is, very, very problematic. And so, I do think that that's probably the route the Fed's going to go. They're going to try and use yield curve control in these things, but that in itself might create an asset price bust. If inflation's running 5, 6%, and you're getting nothing from risk-free assets and, I'm sorry, from treasuries, that, like I said, it's not pleasant to think about either route, but I think if inflation is running 5, 6, 7, people are not going to be excited about, buying a SPAC, or that type of thing that offers no dividend, nothing. And so, it's right. I mean, it's impossible to game, but I do think that the Fed has said that that's what they prefer inflation to run too hot. And so I think that's the road we're headed to.
Okay. Well, we're going to talk in just a second about, so what do you do to prepare for that type of future? I saw a tweet yesterday. I'll try to superimpose here if I can find it after this video. But it basically, a tweet I wrote yesterday where I was sort of retweeting another tweet, which had cost increases for most of the major assets that we sort of depend on for a living, right? Lumber, metals, agricultural commodities, that type of stuff. And they're all up double to triple digits over the past year. And then the CPI came out, the core inflation rate of 1.4%. And I think everybody, has their opinion that that's a highly manipulated number, but it's so funny that they expect us to believe that inflation's trending only about 1.5%, when all of the things we literally depend on to live are going up by, double to triple digits annually.
Yeah, I mean, the only thing you need to do there to understand that is replace owner's equivalent rent with actual home prices. And if you do that, inflation's running 2.5%, 3%. So I
Yeah.
mean, it's owner's equivalent rent, this idea that we are going to poll homeowners to say, if you could rent your house today, what do you think it would rent for? And that's what we're going to plug into that inflation number, which is like 40%. It's a huge number. Percentage of core CPI is this owner's equivalent rent, which is not even a real number. So it's I'm not one of these inflation conspiracy theorists, but just literally plug in a real price for the instead of owner's equivalent rent, which is a poll, and you get a much more accurate inflation number, I think.
Yeah, and just adding to that, and a lot of this is due to the housing price inflation that's part of this whole asset price mania that we're talking about. They just announced that I think a third of all houses are what are they? There's a term they use, but basically the value of the house is twice that of the underlying mortgage. All right, so basically, never before in U.S. history have sort of this many homes been this in the money. Versus their mortgages. And it's great if you're a homeowner, or at least one of those 1/3 of homeowners. But it's just again another sign that the appreciation of home prices is at record levels. So all right, let's get to the question that I think all of our viewers are struggling with here long before this video, but I think you've really put your finger on their wound here, which is, oh my God, all right, we've got these we're at this fork in the road, and neither path really seems like it's super appealing. Like there's going to be pain no matter which path we go down. So how do I prevent myself from becoming collateral damage in this world? So Jesse, you're a researcher, as you sort of look ahead and advise investors, what are some of the things that you're seeing, and what are some of the sort of general considerations that you recommend people, contend with and think about here in terms of, at a minimum, trying to preserve wealth going forward into this environment, and B, for those that are sort of looking to position themselves to, maybe get some prudent growth in there, what sectors they might be looking at?
Well, I think I've been writing for at least 5 years now that you need to own some real assets. Gold has performed really well over the past 5 years, but I do think generally most people are focused on stocks and bonds, financial assets only, and they don't think too much about real assets. And so I do think you got to have a significant allocation to real assets, whether that's gold, commodities, tips, real estate. I do think there's still a great deal of value there. I think in terms of equities, I'm limiting my equity exposure as much as I possibly can. The only equity exposure I really want to have right now, to me, I've been just pounding the table bullish on the oil patch since last fall. Back September, October, to me, these oil and gas producers, so many of these stocks, they reminded me of the gold mining stocks back in late 2015 or very early 16. They're completely left for dead. The stocks were basically pricing in bankruptcy, for most of them. And you had a guy like Harold Hamm, who's, okay, well, I'll back up the truck and buy $150 million of my own stock with his own money. That's Continental Resources. So there's stocks like that to me, are special situations that I think are fit in line with that inflationary framework. I do think that, I mentioned the economy could boom when it fully reopens. Part of that, could lead to oil shortages. I don't think people really appreciate that the fracking, the shale sector can't just come back online as quickly as it has in the past. And so there's opportunity to me in energy, and that's really the only sector in the there's probably some relative value still in the financial sector also with the yield curve steepening. But generally, I want to limit equity exposure. I want nothing to do with bonds. To me, getting paid little over 1% on a 10-year Treasury note when inflation's running well above that makes zero sense. I want to make sure I have a significant allocation to gold and probably some other real assets.
All right, so that's great. That's very consistent, both with what a number of our specialists have said on recent videos like this, and also I'll be talking with the folks from New Harbor in just a moment, and that very much was sort of their outlook in their portfolio strategy. Jesse, in terms of your earlier comments that we're seeing lots of indicators there that historically have presaged a sizable market correction, and lots of people are saying that, hey, we're overdue for one. In fact, lots of people who are more and more parts of the establishment. These aren't the doom and gloom guys. These are highly respected and legendary investors. Jeremy Grantham, sort of the latest one to come out and say, I'm just telling you what history says, and history says in this type of environment, when a bull market has run this long up to these heights, it has always inevitably corrected by 50% within months, was just how he saw the data. So I guess what I'm asking for is what's your advice to people about positioning for the possibility of a crash like that? In other words, do you feel that holding some cash is a sensible thing to do right now, or are the inflation concerns around cash so great that, hey, just get invested in real assets, and yeah, they'll go down in a correction, but they'll come back faster than the stocks will? Or I don't want to put words in your mouth, but what do you think?
Yeah, no, I think I've written about, three possibilities for people to look at based on their, risk appetite, experience, these types of things. I think first, reducing equity exposure and holding cash is probably the best thing for most people to do. It's the easiest thing to do, is just reduce your equity exposure as far as you're comfortable doing. I think for a lot of people too, if you have unrealized capital gains, you don't want to create a taxable event. There are some simple tail hedging strategies you can use. Every month, buy deeply out of the money, put options on the S&P 500. I've written about that. That's a free blog post on my site that came from Mark Spitznagel's book. And so with the VIX relatively high, puts are still pretty expensive today. So I do think for those that are a little bit more interested in trading, a little bit more intrepid in terms of their risk appetite, trying to outright short sell some things, using a very standard, highly disciplined trading framework makes sense. And by that, I simply mean that you're taking losses quickly, right? We've seen with the GameStop thing, coming from a hedge fund myself, it's absolutely astounding to me to watch anybody short GameStop and allow that stock to go against them in the way that Melvin Capital did. I mean, those guys know what they're doing, some of the best short sellers in the business, but to me, I'm not going to hold a short that's going against me. Almost as soon as it starts going against me, I'm covering and getting out. But so it might take, Jesse Livermore wrote about this in leading up to the 1929 crash, how he put out testers. And if it started working, then you potentially pyramid that and add to that position. But if it doesn't work, you got to take the position off and get out of the way. And so to me, I think for people who really want to trade, try and trade from the dark side, as I call it, as long as you're highly disciplined, I think that's where probably the big opportunity is going to be over the next few months.
All right, really well said. Well, Jesse, look, I've got a number of other questions that we didn't get to, so I hope we can have you back on again at some point in 2021. It might not even be that long before some of the things we talk about may have transpired. You've got some great posts on your website. The ones that I'm sad I didn't get a chance to talk to you about were your two. One was called "The Art of Doing Nothing," and then contrasting that with the courage to act. But I will leave it to the listeners to go read those for themselves if they want. And again, hopefully we can maybe talk about those, your philosophies behind those when you're on next. As we wrap up here, where can folks who have really been inspired and energized by your insights here, where can they go to learn more about you and your work?
Well, yeah, I put up a blog post once, either a blog post or a podcast once a week at thefelderreport.com. And I'm pretty active on Twitter. It's at Jesse Felder. I do tons of reading and going through charts and things, and I share most of what I find of interest there on Twitter on a daily basis. So it's just at Jesse Felder.
Thank you.
All right, great. Well, Jesse, thanks so much for coming on, for giving us so much time today. It was super pleasure. So thanks so much. And again, like I said, I hope we get to have you back on soon.
Yeah, thanks for having me. It was a great time. I appreciate the invite.
Thanks.